What is going on with this market? I mean, it seems so crazy, right? Interest rates are up, then they're down a little bit, then they're back up. We think they're going to go down even further, and they go back up even more. Now, as of today, March 6th, they actually settled back down a little bit, even though the Fed hadn't cut the rates and certain things came in positive, but there was a few things that came in negative. And I did a video on that last week talking about interest rates and what's going on there. But what's actually going on with sales? What's happening out there in the market? So I've got a lot of numbers, basically a February recap on where we're at in the Las Vegas and Henderson market. And I'm going to focus a lot on the single family residences. So there's more sold because of condos and townhomes and multifamily, but it all extrapolates out to be about the same. So on a year over year basis, we're actually down about 6.1% in sales. Now that's in sales volume, so it's really important to just know that that means that, well, if we sold 1,000 single family properties in February of 2024, we've now sold 939 or 61 or 6.1% less than last year. Ironically, with the high interest rates, with the fact that we have lower sales, we're actually up on our prices. As a matter of fact, our average home price is up 5.8%. And our median home price is up 5.4%. Again, that's on a year over year from February of 25 to February of 24 last year. So slower sales, but everything's costing more money. Now, why is that? Well, it's a host of different reasons. There are actually a lot more new home sales going on now than normally in a market. Oftentimes that makes up 15 to 20% of the market. Right now it's making up more like 40% of the market. And the reason being is because the new home builders are offering great incentives. They're offering lower interest rates. They're offering closing cost help. So therefore, they're increasing the overall price of the homes, and because of the cost of goods, all of the supply chain scenarios, there's actually a higher cost to the builder. But then with all the buy downs and incentives, as long as they could get the home to appraise, well, it's going to go up. Resale follows those new homes because a lot of people, even though they might pay a higher interest rate or not get as many concessions on a resale home, there's a lot of things that are done. The backyard landscaping is done, the pool's done, there's window coverings, things of that nature that they may not be getting with the new home. We could certainly help with resale homes as well as new homes. So if you do have any questions, we'd love to answer those for you. But continuing on with the information in regards to the overall sales and what the picture looks like here, there's some other great information. Now, interestingly, February had a 12.9% growth in overall sales from just the month before in January of 2025. Additionally, the median home price was flat. However, the average home price increased by 22.3%. What that means is there's a lot more higher end homes. It might not necessarily be luxury, but it might be the $800,000, $900,000 price point here, where that median is more in the high fours. That is actually driving that number up. So the average price has gone up, just more higher end sales and less of the economy sales and kind of median price point sales. And that's what's driving that. Overall, it's really a bullish market. As much as sales have decreased from a certain perspective, the excitement about buying a home is still there. The people that need to buy are absolutely buying, and they're willing to pay the price for the home based on ultimately what that value is. Now, part of that is a result of Vegas being a mecca for so many other areas that are relocating here, and those other areas are definitely more expensive when it comes to the home. So they might have sold their home, have a lot of equity, and when it comes to competition, they're going to outbid that other party on some of the great homes that are out there. Now, our inventory has also gone up, but we're still not really rich in inventory. I mean, if you look at the inventory now versus the inventory numbers, even in, say, 2016, 17, 18, which was a pretty normal market, we're still fairly thin. What's really deceiving about the inventory that we do have is a lot of it has been on the market for a long time. As a matter of fact, there's one particular investor that bought hundreds of homes, and at one time I saw that they had 1,200 homes on the market at one time, and they were all a bit difficult to get into, a little bit overpriced, and that really inflates the market. I was just looking a couple weeks ago at one of the high-rise towers and looking for some units in there, and there were a couple that were really outside of the normal price range, and I was kind of curious about it, and I realized that those homes had actually been on the market for 3,800 days. So they were approaching 11 years on the market. So when you take and pull all of those out of inventory, the actual inventory of homes that are priced right that people want is actually pretty thin. So we really have to distill that down, and a lot of people don't look at that aspect of the market. They look at the overall number and they go, oh wow, we're approaching a buyer's market. Well, we're not necessarily. We're still in a neutral and probably even favoring the seller a little bit. What the benefit is to the buyer, and the reason it is acting in certain cases like a buyer's market, is simply because of the economics behind things. Buyers are being a little more discerning. If they don't find what they like, they're willing to wait a little bit longer, because if they're going to pay the price and they're going to pay the interest rate, then they're not just going to go and settle for something. Now in 2021, if you guys remember the frenzy, it was this fear of missing out. I mean, the same thing happened with used cars and Rolex watches, where people were just spending through the roof for these items, thinking that they might miss out and not have a car as a result of not acting fast, that they were not going to be able to get a house. And whether that was a fear of truly homelessness or just not being able to make the moves that they wanted to make, they were going and doing things that were outside of the typical consumer behavior and character. So we don't have that right now. So that's where it acts a little bit like a buyer's market. So we are seeing seller concessions and rate buy downs paid for by the seller in a lot of cases, just because of the fact that there is a little bit of a buyer advantage. Now, when we see rates get into the fives or even low fives or high fours, that's likely when we're going to see all of that dry up. The sellers are going to take charge again, and it's going to be a matter of what the buyers are willing to put forth, and they're going to have to come in with their absolute best offer, asking for the least possible. Again, there's always ways to structure it. So if you're a buyer out there and you're worried about those times, and you're in a position, a conditional position where you have to wait, maybe it's based on retirement or job relocation or something that's very specific, that has nothing to do necessarily with rates or prices, but it's just a time sensitive scenario, and you're worried that it's going to be like that, there's always a way for a great agent to give you the right direction and the right guidance to structure that offer properly so you can get what you need. However, it does just get a little bit tougher, and you might have to go through a few rounds of that before you actually land on exactly where it is that you're going to be. So let's get back into some more of the numbers here. So there are, when I'm talking about the inventory, there are actually about 5,200 homes on the market, which is plus about 0.3% from last month. However, it is actually up 50.6% from this time last year. So again, you can see that the inventory is really starting to increase. Now, one of the reasons that it was artificially low last year is that it was still a mentality of a lot of sellers that I'm not going to sell my house that's at a 2.5%, 3%, 3.25%, 3.5% rate when rates are in the sevens and maybe even approaching 8%, right? Why would I trade in my, let's say, $500,000 house, even if I was downsizing and gonna buy a nice $300,000 condo? Why would I trade in my $500,000 house for a $300,000 condo when the payment's gonna be the same, because I had a 3% rate on my $500,000 and now I'm gonna have a 7.5% rate on my $300,000? So people were holding on. Well, we've reset the watermark and there's a new norm. There are still people that are holding on to those homes. I'm one of them. I have no intention of leaving my home. I've got a great rate. However, there were people that were holding back on needs of theirs, growing families, maybe downsizing families, and they've come to the conclusion that I'm going to do it now because I'd rather buy that house, or I'd rather sell that house at $500,000, buy into the condo that I'd like at $300,000, revise my lifestyle and get on with it, even if it's the same price, because when rates do come down, I could always refinance. And that's a little bit more of the normalcy that's set in. So we are seeing a lot more sellers being willing to actually list their home, even if it was at a lower rate, which does leave one opportunity, which is assumable mortgages. A lot of people think that assumable mortgages don't exist anymore, that they were a thing of the 80s, back in the Carter days. And that's not the case. Assumable mortgages have always been here. It is specific mortgages that allow assumptions. The two that absolutely do are FHA and VA. There's also USDA that will allow for those as well. There are some caveats, especially with the VA mortgages in regards to being assumable, but I've also done a video on assumable mortgages, and you could find that in the playlist below, or if it's not there yet, it will be coming out very soon. Now, again, when it comes to the different opportunities here, again, there's assumables, there's rate buy downs, or there's just the hold out and wait, right? As rates come down, then there's that opportunity to refinance, as I mentioned. So again, there's a lot of homeowners that are willing to get off the fence now and list their homes and see what they can get for them. And that's a big reason why we're seeing that increase in inventory. Now, one reason we're not seeing the increase in inventory that I want to make sure that everybody knows is foreclosures and short sales. We still don't have a scenario where we have a huge amount of foreclosures and short sales. So with the inventory numbers that I'm talking about, what that results in is about 2.9 months worth of inventory. Why is that important? Well, we always talk about the markets in regards to months of inventory. What that means is that if another new home was not put on the market, new doesn't mean a brand new home from a builder, but any sort of new listing on the market. If there's not another one put on the market, then 2.9 months is how long it would take to buy all of the inventory on the market based on how many buyers are making offers and closing on their purchases. So that's all we have, is just shy of 3 months. A seller's market is considered 0 to 4 months. A neutral market is 4 to 6 months, and a buyer's market is when there's 6 months and longer in regards to how much inventory there is on the market. So you can see, again, this is still technically a seller's market because we still do have demand and the supply is not enough to offset it. So it goes back to 10th grade economics and learning about supply demand, or maybe that was even earlier in the educational journey. So one of the reasons that a lot of people may think inventory is growing, which is not the case, but it has happened in the past, is foreclosures and short sales. And we're really not seeing that because the negative equity situation on homes now is the lowest it's been pretty much in at least my history in life. We are down to 0.8% of homes that have negative equity. Now, why is that? Well, one, because again, a lot of the homes were bought with a decent amount of equity, and we've had such an increase in the value of homes over the past decade that buying a home and being upside down on it is unlikely unless you're in a market, and there are some markets across the country that has actually experienced a decrease in value. But any of the markets that are still experience a trajectory, even if it's plateauing and pretty level, you're not seeing the negative equity situations. So now when it comes to mortgage defaults, and that means that somebody's going to either have to short sell their home or they're going to get something called an NOD, or a notice of default, and that's when the bank is starting the foreclosure proceedings. Well, they've also gone down dramatically over the past decade or so. The height was at the very end of 2009, 15 years ago. They had 134,000 foreclosure notices here in Nevada. From that peak to about 2016, it was a slope downward. And from 2016 to 2019, we were under 20,000. I mean, get that. We went from 134,000 active foreclosures to under 20,000. Now, we did have a bit of a spike. When COVID happened, as you know, a lot of people were put out of their jobs. And while there was some strong unemployment, some stimulus going on, for a lot of people, that wasn't enough to maintain exactly what they had. And there was also a slight little dip in the market before everything skyrocketed back up. As a result, that led to about 43,000 foreclosures in the Nevada market. And that has, again, been like a ski slope downwards till now. And right now, we're at about 13,400 foreclosures in the entire state of Nevada. So when you look at that, and again, that's not active on the market. Those are people that are somewhere in some form of default, where they may have to short sell, where they may in 3 or 4 or 6 or 8 months get a notice of default and actually go to auction or be put on the market as an REO. So it's not 13,000 that are active on the market throughout the state of Nevada. Again, our numbers were very low earlier. It was 5,000 and change single family residences, probably about 8 to 9,000 if you're including condos, townhomes, and multifamily and high rises. So that's certainly not indicative of what's on the market. There's very, very few foreclosures actually active on the market right now. So that is not at all what's driving inventory. The great news is, as I mentioned, we have more equity than we've ever had in homes. So while consumer debt is going up, and that is a little frightening, the equity in homes is stronger than it's ever been. There's actually many, many homes that are under 40% equity. I think the average right now is about 45%. So that's for those that are paid off in totality, and those that are a brand new mortgage and owe 96.5% on them. So that news is actually really good and really stable overall from an economic standpoint. We've also seen a tailing off of rents. They peaked back in the fourth quarter of 2022, and they've tailed off ever so slightly. I mean, we're talking, $50 to $80 down from where that peak was, and they're pretty stable where they're at right now, whether it's an apartment or a rental home. And that's good in certain ways. So if somebody is waiting to buy a home, they may actually be able to rent a comparable home for a little bit less than what that mortgage is. However, there is still a cost of waiting because, again, you're offsetting equity gains, some tax benefits, and what have you. So if you're just looking at the raw number, there's a lot more to it, and that's why you want to get a great mortgage professional or a great real estate agent that really understands these things to talk to you about exactly what the truth and consequences are with the decisions that you may be making for yourself and your family. And I had mentioned earlier that new home sales were going up. Just to give you an actual idea of what that means, last year that we have the data for it, and it's actually gone up a little more since then, is 2023, where there were 30,483 resale closings, and there were 10,442 new home closings. So again, it's at about a 3-to-1 ratio. That resulted in 25.5% of all homes being sold being new builds. So how does this relate to you? What does this mean for you if you're a seller or a potential buyer? Well, there's a lot to unpack there, and ultimately it depends on exactly what your considerations are. What is it that you want? What is it that you need? And based on that and talking to a great real estate professional, you'll be able to really forge a path forward. A great real estate professional, the difference is they're not looking for a transaction, they're looking for a relationship. That means that they're not looking to sell your house or have you buy a house right now today. They're looking for what's in your best interest, and they want to really guide you on the path of what's right for you. Whether that means you're never buying or selling, or that means that you're buying or selling now, 6 months from now, or 5 years from now. That's what somebody's going to do for you that is doing things correctly. And if you have any questions for me, I'd love to be a resource for you. So go ahead and comment below or give me a call. The number's below in the description notes. And I would love to hear from you, hear what you have to say about what's going on in the market, hear any of the questions that you may have. Again, there's a lot to unpack, and I don't have a one-size-fits-all answer. If I just said, oh, you should buy because, well, home prices are going to continue up, but your considerations are based on something completely different, again, conditional versus objection, then that could be all the wrong advice. So I would love to talk to you about your specific situation and see what it is that I can do to help you to add value and give you the guidance that you may be needing. So if you have any considerations around real estate, around buying, selling, investing, again, whether it's now or 5 years from now, I would love to be that resource for you. Hope this market update gives you all the information you've been craving, and I will see you on the next one.